Good afternoon and welcome everybody to the last in this series of IMAP webinars on transforming advice businesses into wealth management. Through this week, we've had some really interesting discussions with people who come from a high net worth client basis and an accounting basis. And today, in some ways, we are drawing those threads together with Matthew Swieconek from Findex, with, of course, the Crow-Hallworth relationship there and their client base, and Piers Bolger from Viridian, which, as many of you will know, is pitched towards the top of the advice market, and moderated again, as we have been through this week, by Paul Forbes, the CEO of Australian Advice Network. Before I hand over to Paul, for what I know will be a fascinating discussion, let me just talk a little about a couple of things which we've got coming up. The awards submissions close, well, today, but often there are late entrants. And so if you've got something left to finish over the weekend, don't worry, send it in. We've already got a good batch of award entrants, but we look forward to using the awards to showcase best interests. And in fact, we're joined today by Piers, who has been a winner of the IMAP Awards in previous years. On the 2nd of June, we'll be running a webinar with Adrian Quah, who's prepared a submission on the quality of advice review. And we'll be talking about the quality of advice review and the contributions which IMAP has made to his submission and our thinking about the role that managed accounts play in delivering better advice outcomes to more people at an affordable cost, and the absolutely central role that managed accounts of all sorts can play in improving the quality of advice. And then, of course, in June, importantly for us, in Melbourne, Sydney and Brisbane on the 14th, 16th and 21st of June, we have our Advice in Action conference, where we really try to focus on many of the issues that affect good business practice and advice, not just managed accounts, but also other issues such as technology, the competition for talent amongst advisors. Believe me, that's not a problem that's going away anytime soon. I hate to bang the same drum, but of course, more efficiency comes from the use of managed accounts. I'd encourage you to come along for what will be a really interesting practitioner-filled day of content. How to ask a question? We'd encourage questions. We've had some excellent questions as we've gone through this week. So the Q&A button at the bottom will feed straight through to the panelists. So now it's my pleasure to welcome Paul Forbes, Matthew Swieconek and Piers Bolger to talk to us about the strategic implications of wealth management for advice businesses. Thanks, Paul. Thanks, guys.
Thanks, Toby, and thanks to all the people who've logged on. So it's obviously the third one for the week, but it's been an interesting journey. So we've actually looked at some very different businesses, and I think these two businesses, which both Piers and Matthew are heavily involved in, are a great way to finish the journey, because obviously well-established businesses and certainly dealing with that whole integration of advice and wealth. And a long way away from the old institutional model. So it's going to be a very interesting next 50 minutes. So thanks, gentlemen. Before we start, we might just get Matthew and Piers to actually do a quick summary of backgrounds and introduce themselves. I'll start with Matthew, if that's okay, Matt. I'll throw
Absolutely.
to you.
Yeah, thanks, Paul. And look, thanks to Toby and IMAP for hosting us today. Really appreciate the opportunity to have this conversation. So as Paul and Toby mentioned, Matt Swieconek, I'm a managing partner in our wealth management business here at Findex. So I've been with the group just going on 16 years. For those of you who are unfamiliar with Findex, because many are, it's a business that's grown via acquisition over the journey. So I was actually part of an acquisition when I came into this business. So I actually say I've got a 20-year relationship with Findex. So I've started off as an advisor with the business from the outset, but moved through the business over the journey when we were a group of 50 or 60 people back in 2006 to where we sit now at just sub 3,000 staff. And my role now is accountable for looking after the advisor force here in New South Wales and up in Queensland, from all the way from Sydney through to Cairns. So a pretty lengthy remit.
Fantastic. And Piers.
Thanks, Paul, and good afternoon, everyone. So Infinity Asset Management is the investment arm of the broader Viridian Financial Group, which has a private wealth offering as well as an investment offering through Infinity. I'm the Chief Investment Officer here at Infinity. We set the business up when we founded Viridian back in September of 2015, and we've been offering managed accounts over the last 5 into 6 years now across the business. And prior to that, I was head of diversified portfolio management at BT Financial Group, and my background's been either on the investment management or consulting side over the journey.
Okay. Yeah, well, I think a lot of change going over in your old shop at the moment as well, I think, mate. So
very much so. Should we call it Mercer? So
right. All right. So if we talked about this, now one of the things which I think I do want to get onto is how managed accounts work from an AFSL point of view. So I think that there's some protection mechanisms on that one. But I think if we look, Matthew, from your point of view, from a having been part of that whole journey for 20 odd years, right? Can we talk a little bit about why you believe managed accounts should actually be part of the solution for a group like Findex?
Yes. So look, I guess from our perspective, Paul, we've got a really proliferated workforce. So we've got 110 locations across the country. So for us, it was always a case of, even though we weren't always of that size when the business commenced, we've always had a number of locations. Importantly, we are a corporatised business, so all of our advisors are representatives, salaried employees of the business. But it's always been really important for us to have a consistent investment methodology and approach. And the managed discretionary account that we run really serves that purpose well. It allows us to have a really consistent framework, allows us to invest in all of the infrastructure that sits behind that as far as research and compliance and so forth is concerned. So from our perspective, it's really about having that consistent. We want a client to have the same experience from an investment perspective in Toowoomba than they do in Townsville down to Hobart.
Yep.
And it really allows us to do that over the spectrum of our offices.
Yeah, I think and that's not an unusual thing. There's only 4 practices now licensed, but it's still, when you go to that point, money doesn't know where it is. It doesn't matter if it's in Toowoomba, and doesn't matter if it's in Sydney. It more comes down to what you're trying to achieve for that individual, which is great. So Piers, I look at that the business from your point of view coming out of BT. Do you feel building what you've built now in Infinity, do you think you were building something different for Infinity versus building something within a large corporate institution?
Oh, I think, no doubt. I mean, when we set the business up and managed accounts were, in their infancy way back in, 2015, 2016, we felt very strongly around providing clients with a solution-based outcome. And, Matt articulated it very well in the context between, Townsville and Hobart. You want that consistency. And the framework that we've always worked upon is to provide, what we would say is institutional grade investment IP that is standalone and separate to the advice business. It needs to be, as we all know, under the best interest duty and the appropriate nature of that, but deliver into our advice channels as well as to external channels as well, that institutional grade, and have the ability around managed accounts, which do provide, in our view, some flexibility and some quite significant advantages. And that was sort of the framework that we've adopted over the journey, and continue to believe that it's only going to get better as the managed account offering more broadly within the industry evolves.
Yeah. So, if looking at that from point of view of how you started, so and I think, look, to be honest, a lot of people listening are either in infancy of this, or they're in the wave. They might be building managed account solutions, or they might be looking for a solution. So, did you start? And I think a lot of us evolve, but did you start with a managed account solution inside the license and then take it out, or did you always build it in a silo?
No, we always built it in a silo.
Yep.
And we took the view that the investment management team don't provide advice at all. So
Yep.
there was no advisors within Infinity. And again, we think that is, absolutely critical to provide that separation in the context of, is the Infinity solution appropriate for every client? No. But you want the determination of that to be driven by the advice relationship.
Yeah.
And in the context of, building that out, what really requires, from a business point of view, if firms are looking at this, you need to be prepared for all the challenges associated with doing that, particularly if you're an advice practitioner who loves providing advice, but equally loves getting into the nitty-gritty around the investments piece. We found, and certainly when we were looking at our, the RE coming back to us as an example, as well as platforms, are saying, well, you can't do both. And so that then creates a nexus within the business. You might have a really good advisor who just wants to focus on investing. That's fine. They've even got to give up their clients. What happens to that advisor and what they're bringing into the firm, whether it be in terms of education, new business, etc. So, we were very clear in the early day. I was never an advisor, so we didn't have that problem. But I think it is one of the challenges, because the startup costs are significant, and you need to be prepared for that, particularly if it hits your P&L on that side of things.
Yeah. And Matt, I don't know the history of how it started there for you guys, but was it internal, or were there advisors involved?
Look, we many moons ago, we used to operate in a master trust environment. We've always had that top-down philosophy, but where we've evolved is in the desire to provide more transparency to our clients. So, making portfolios much more clearer and transparent in terms of what underlying holdings are and so forth. We've always had, I guess, what I'd call an internal silo, where we've had a function within our business, a research division within our business, an investment committee within our business that was separate from the advice component that Piers is, alluding to there. We are very strong on making sure that there's that delineation between the strategic and advice component that our advisors are giving, and then a separate part of our business, which is our research division and our investment division, that basically formulates all of the portfolio construction that our advisors tap into.
So I'm interested from both of your points of view. So and I suppose this is probably more because this is how we've always thought about it, that we actually see wealth management from an advice point of view as being slightly different from funds management. In that, and I suppose I wouldn't mind exploring that a little bit. I know it's a bit of a play on words, but do you think the solutions you built would have been the same sort of solutions you'd expect to see from a large, diversified institutional manager? So, pick a BT. Or are you building the same solution, or are you building something which has more downside protection? Or do you, Matt, first?
I guess, look, if I look at, wealth management to us encompasses our whole financial planning process. So, we start, as everyone on this particular call will do. We go through our clients' needs and objectives, and we seek to achieve those via strategic means, whatever they may be. Our investment management and portfolio construction is one part of that equation, but it's a separate part of that equation, but it's an acquired part of the equation nonetheless. Our process will go so far as selecting the asset allocation and the underlying managers from an unlisted sense, or we will select mandate managers if there are direct models and portfolios that we're putting together. But we we stop there, and we're employing the fund managers and the mandate managers to actually select the underlying securities, whether they're shares or bonds or A-REITs, etc. That's the funds management, I guess, capability that we don't go as far as moving into. But we feel that, we've got a very diverse client base, and a lot of those clients, particularly in our high net worth, ultra high net worth space, have numerous entities, a lot of complexity. They might be partners at audit firms that have particular requirements. So I guess from our perspective, it's important to have that element of tailoring as well, that you may not otherwise get in what I'll term an off-the-shelf offering with maybe one of the institutions, for example.
Very cool. And Piers, and any thoughts on that at all?
Oh no, just to reiterate that to Matt's point. I mean, we clearly as a firm has separated out, strategic advice from the investment side of things, and the conversation. I think the wealth conversation that our advisors have is built around that the entire aspect associated with it. And, we provide a sleeve into that, as Matt alludes to.
So with the expectation for both, so with the advisors, Piers, and this is one of those questions a lot of fund managers always had. So fund managers say we're fully invested because we're taking your instruction, and therefore, we expect maybe the advisor and the AFSL, but also specifically the advisor to make decisions on things like increasing cash holdings or increasing defensive assets in volatile times. Is that? Do you have a different thought process on that, being part or being firmly attached to a large advice group, or do you still stick with that one?
We have within the portfolios, obviously portfolio guidelines, and we have the flexibility within those guidelines that we have, and where we decide to and we can hold significant amounts of cash, we may do that. But there is an asset allocation decision taken within the way that we manage those portfolios. And to your point, Paul, there's absolutely an asset allocation decision between the client and the advisor as to what's appropriate for the client at any particular point in time. And, we may or may not be a solution suitable given our view on the market or how we're managing those portfolios at that time. And that's why I think it is particularly important that you have that separation, that clients then understand that the advisor is clearly operating in their best interest, even if, as I said, across our organisation, we have a private wealth as well as an investment management part of the broader group.
Yeah, and your team much the same, Matthew?
Sorry.
As far as fully invested, you're letting the advisors make the decision behind the scenes on defensive, or would you get more defensive with cash or using other?
Our portfolios, the construction of our asset allocation is done at a committee level. So for a given risk profile, our model portfolios will be dictated by our investment committee, and we take inputs from State Street, who provide us their asset allocation views on a quarterly basis. So in accordance with those sort of positions, we will actually do that on a top-down basis. Our advisors won't make decisions on the growth and defensive splits within a particular client portfolio. But what I would say to that is that they will be able to make adjustments to cash holdings and so forth if that's the way that they wish to make a client's portfolio more defensive for a particular reason, or if a client instructs them to do that.
Yeah, very cool. I know, Matthew, you've already mentioned that you're doing a lot of strategic asset allocation, and I'll come back on the tactical piece. And one of the questions there is obviously you're then doing a selection of fund managers. Are they running mandates for you, or are you using a retail option, or?
No. So we do have a number of managers running mandates for us. So I guess we're fortunate in that the scale that we have allows us to negotiate maybe new unit classes for a particular existing strategy that a manager might have, or with a direct equity mandate, because we have a series of models that are listed and a series of models that are unlisted. So it really depends on what the client preference will be. But yes, we will typically have a mandate.
Cool. And so, Piers, are you guys actually doing the direct asset selection, or are you outsourcing a portion of that?
No, well, we do that particularly in Australian equities, but follow a similar path in the sense to the way Matt alluded to, where we do have some wholesale vehicles, and then we do have some mandates across our portfolios, just depending upon the nature of the strategy and what we're trying to build into the overall portfolio construct.
Yeah. Right. And if looking through your portfolios, would you say you tend to, but in Australian equities, for example, would you be looking at running a number of different styles, or probably Piers, not for you because you're actually obviously managing that money, but would you then say, all right, then we work more on a concentrated portfolio or broadly diversified? Yeah.
We do run a core Aussie equity and a small to mid cap long only. So they're relatively concentrated portfolios, 25 stocks maximum in each, and we sort of run anywhere between sort of 22 to 25, depending upon market conditions. But, where we might utilise the skill set of an external manager might be in something like long short, for example, where you think, where we believe actually that you do require some specialist skills, and we, requirements there we think are slightly more onerous. So we would then work with, the managers that we have in that part of the portfolio, work with them around that. So, that's the work that, the team does in that identification process, as well as obviously the bottom up work associated with, individual security selection.
Cool. And Matt, are you so if we talk about international equities, would you be running a number of different styles in there, or if you're in your blending, or?
Yeah, we would, and we do. We're typically looking at the various cap sizes, trying to get a blend across all of the different sort of sized companies, in much the same way as we would do in the Aussie equity space, trying to get a SMID, a large cap. But we also, I guess, depending upon views on markets, we'll look at the various styles of the managers themselves around whether the growth and value managers, quality managers, etc. And that's essentially something that we review on a quarterly basis across every one of our models.
Right. Can we talk a little bit about tactical, if we would? So, first off, how many models do you run there, Matt, in your managed accounts? Sounds like you got a few.
Yeah, we have upwards of 50 models. Okay. Yeah, we've got enough. Look, and it really depends, and this is why the MDA suits our business, because we have 7 base risk profiles that we categorise. Obviously, advisors will go through the risk profiling exercise with all clients and select the appropriate risk profile. But within that risk profile, there are several different model choices that they can select from, whether they're listed, unlisted, active, semi-active, passive, or a mixture. Yep. We also have clients that may wish to take up a sector only, or a series of sectors. So we have a lot of clients who may, for example, manage their own property portfolios. So we will remove that from the mix and rebalance all of the other sectors around that particular holding. So I guess that probably gives you a bit of insight as to why there are so many. It's a bit of a building blocks approach, as we call it, because of the variety of clients that we do have, and it allows us the flexibility to put all sorts of clients have, as we know, particular preferences for various holdings that they don't wish to, despite sometimes our best advice, don't wish to redeem and sell down, or there might be capital gains, whatever the case may be. So they may have a preference to hold on particular assets. We've got the capability to put holds on those assets and rebalance around them as well. So there's a wide range. Yeah,
that's cool. And Piers, from so strategic asset allocation. I think what we hear from Matt there was they're actually obviously doing a lot of tailoring in there. A bit more difficult if you're doing the management. And so how many models would you manage?
So we run 13 portfolios. So we run 5 sector-based strategies covering the broad asset classes, global, DFI, alts, etc. 6 multi-asset, standalone multi-asset strategies. So the sector portfolios don't become building blocks of the multi-asset, and then the 2 direct equity strategies. We are relatively, we adopt, a dynamic asset allocation framework. We see the value in asset allocation, particularly in, market environments that we're in at the moment. But the construct around our formation of the portfolios always hinges back to a base case, which is underpinned by our capital markets work. And we think that that's particularly important in the way that advisors articulate what role the portfolio is playing in the client's overall portfolio.
Yep.
And how the portfolio should play out in time, particularly around sort of the risk and return characteristics of that. So, but we think that it certainly isn't, we don't adopt a set and forget approach around the management of the asset allocation or the underlying securities. And I think that actually is one of the big advantages for advisors in their engagement model with clients, even though they may only be seeing the client 3, 4, 5 times a year or only once a year. The portfolios are getting continually reviewed, so the clients have that comfort level.
Yeah.
And I think that that's a really valuable approach. And again, just going back to Matt's original comment, it's a lot easier when you've got that consistency of portfolio construct coming through. No matter if a client is, been in the portfolio for 3+ years or they're a new client going into the portfolio for the first time, that consistency there is particularly important in our view, in the way that you're delivering that holistic advice.
And just to build on that, if I can, I mean, we've acquired a lot of businesses over the journey, and for a given risk profile for practices that have been employing more of an SOA model, for a given risk profile, you'll see wide variations in return profiles and risk. So it's that consistency aspect is something that you just can't replicate readily when you're not in this sort of managed account space in our view.
Yeah, I do want to come back to a little bit about unlisted assets, Matt, because that really interests me. But one of the questions, and I think it's a good one to actually broaden. There's one on ESG. We'll come back to that. But there's the idea that yes, you can do just as simply the same thing in model portfolios for clients. I think most of us from the advice background, exactly that's where this all started. We did build model portfolios for clients. We stuck them on platforms. However, when you build model portfolios and you then change one underlying manager in a model portfolio in the old world, sitting on platforms, obviously there was a significant amount of structural work had to be done. So if your advice business, we did exactly this, which is why we got interested in managed accounts. And back in 2014, we took a manager. We had 400 odd clients, 300 of them had very simple, were probably retirees with a balanced style portfolio. Moving one manager out and replacing them took 330 ROAs and about a year. So I think that some of the fundamentals of building tailored portfolios, MDAs, SMAs, virtual SMAs, really comes out of that frustration with the ability to execute quickly. And from a licensee point of view, there's a whole range of issues in regards to legacy. So Matt, could I probably throw to you on that one? So from an AFSL point of view, how do you see managed accounts or your MDAs protect the AFSL?
I guess for the reasons you and I just probably mentioned, that you're getting. I mean, I know from our experience, we have our investment committee meeting that meets on a quarterly basis. As I've mentioned, we'll set a tactical asset allocation each quarter. It may stay the same, but we'll rebalance each quarter. And within 2 to 3 weeks of that rebalance, of that investment committee meeting process, we'll have somewhere in the order of 21,000 accounts balanced or rebalanced. So all of those clients are going to then get we know that their return profile, their risk profile, and the metrics that go around it will be the same for the next quarter, the next 6 months, for the next 12 months. So the risk mitigation is huge. The efficiencies are huge, and also the friction is lessened. And the client, look, it's a win-win from our perspective, because clearly there are efficiencies in being able to do that, but also the client is getting a much more timely outcome.
And hopefully that answers that question. I think there's a whole range of really different. I mean, whether it's tax structure, the whole lot actually works better in the MDA style or the SMA style. If we're talking about we're talking about strategies in there, and Piers, this is probably, I'll start with you. We'll come back to Matt on this as well. I think as a loan advisor building a model portfolio inside a platform, all right, yes, you've got the available investment list from the platform, but what you gentlemen are doing is building something which is far more complex than that. So can I talk about, Piers, you've already mentioned that you're looking at long short strategies and those things. Now, that's not something which you could choose a fund, but that's not something most advisors would be building into their portfolios.
Yeah, well, I think that, again, it comes back to what you're trying to achieve through your portfolios. And I think you may mention before, I mean, one of the key premises that we think about in terms of our philosophy is managing risk. We believe that if you manage risk well, the rest of it will look after itself. Compound interest is a wonderful eighth wonder of the world, and it's a great thing from a portfolio standpoint. So that's one aspect of that. And then the ability to be able to do that, you need to have, as an open architecture framework as possible in terms of identifying investment opportunities and strategies that can best deliver on that. And again, I think that that's, a skill set. And, you do need teams to be focused on that, and you're not necessarily then beholden by either an APL or a platform open menu. I mean, we have a number of our strategies where it's only offered, platform will only allow it through our managed account portfolios because of their thoughts around, the requirement of sophistication. They wouldn't do that. And I think that's particularly vital because we're trying to provide a solution that meets a particular need from a portfolio and strategy perspective, and we don't want to be hampered or constrained by, either an APL and or a platform menu. I think the key aspect, particularly around platforms, is to have them evolve in their administration functionality to allow firms that are using them in a managed account space to enable those firms to operate as they see appropriate, as opposed to the platform defining what they view to be appropriate for either that firm or the strategy. And I think that's work in progress.
Yep.
But I think it's particularly important. And probably just one other thing, just going back to the last question around, what's the real benefit? I think one of the things, and again, Matt spoke about it, scale through the managed account framework is particularly accretive, depending upon, and I just use rebates as a case in point, where you can negotiate fees at a far sharper level than if you were dealing individually with client by client at a product level. And, those benefits are real. I mean, from our perspective, we're going to be rebating over $4 million back to our client accounts for FY 2022, and that's only going to continue to grow. So, there's some demonstrable advantages that I think that you quite often don't get, people don't necessarily pick up on, but as your portfolios grow, you can really add some value to clients that everyone benefits from.
Yeah, I think, and I'll follow on, Matt, to you, but from Piers' comment, it is an interesting point though. The I as running an AFSL, looking at my advisors, would be very hesitant to have unlisted or a range of unlisted or liquid assets on there. Obviously, dealing with private equity is a whole new minefield as an AFSL. Right? These are things which you can build expertise inside your business and certainly have a much stronger insight into it. And then, can we just talk a little bit about that for the unlisted side?
Yeah, look, the one thing I should probably clarify, my terminology around unlisted is more in the managed fund sense as opposed to the direct equity. So we don't actually do in the unlisted real asset sense. We don't do a great deal in that space at this point in time, because with the profile of our client base, does demand some form of liquidity, and so therefore that is one thing we learnt during the GFC, was to get back to the simplicity of things. And if you've got too much of your portfolios tied up in unlisted assets in that sense, direct property or whatever the case may be, we all know how that has ended for many. So we are all our portfolios are highly liquid in terms of our ability to redeem, but we do have capability in our research team that allows us to basically take on, as Piers was mentioning beforehand, we've got a number of institutional grade sort of quant strategies or long short strategies that don't have a retail presence in the marketplace, and it enables us to put that on our menu and make that available throughout our models. We've got an alternative investment program, which we've got a relationship with an alternative manager in Boston in the US. And in concert with them, we've got an alternative asset strategy that we run through our model portfolios, which has just performed exceptionally well. Just there's a bit of a plug there, but these are the sorts of things I guess it enables us to do, and it doesn't necessarily take away from the liquidity of the portfolio at all.
Yeah, no, I think there's a whole range of things, I think, which. Yeah, so I was probably more thinking you might have actually gone down that track, but I think all of us were a bit burned after GFC. So liquid assets are hard to incorporate generally. We look at industry funds, they've obviously managed to use a whole range of alternative assets, which does allow them to smooth returns, which is certainly a different experience, but it's hard for certainly for businesses who don't have that sort of age profile, to then have illiquid assets sitting in there. If you've got a 30 years to retirement profile, can work. I won't talk about individuals. What about yourself?
Also, just on that place, Paul, I mean, super funds they're cash flow positive, right? Because it's pooled investment. So very different, from, individual clients. Yeah, because you're talking about their individual dollar exposure. So, some of those nuanced aspects that enables them to do that, and artificially in some respects create different profiles is one of the reasons, because they are pooled vehicles and they've got by and large an ongoing positive cash flow coming into.
I think they'd be pleased that the Morrison government didn't actually get up with their ability to draw down on super funds for property. That one was going to cause some more dramas, I think, for a couple of the funds. So there's the comment there. I think we'll leave the long short strategies, etc., because I think there's a whole range of things that can work and not work for you in there. Can we probably move forward a little bit and start talking about how you've been managing current volatility, etc. I mean, one of the things I struggle about, and I get the fact there's an advisor there saying they can manage all this themselves. If the question mark, I suppose, really is the advisor sitting there with broad-based goals-based advice, spending a lot of time on that. Do they have the ability to actually get in there and the nuts and bolts and be all over these changes which are going on in the market? And I think if you get a specialist team inside your businesses and that's their job, yes, they can get it wrong, but at least they're paying attention to it 100% of the time. So I think that can be a little bit. There can be quite a difference between an asset management team and an individual advisor managing a portfolio. So maybe just walking more into yours, Piers. So as far as your team, so resources wise, you would have started off relatively small. What's your team look like now?
So we have 7 on our portfolio management team now, and we deliberately keep it relatively tight. The reason for that is that we're not required to research the market. I mean, the advice business draws on research from other providers in the marketplace as it relates to its APL. And our focus is solely around the portfolios and identifying opportunities, and that works really well. I think you made a really good point before just on that, Paul. I mean, we did over, if we're just looking at the unlisted side of it, we did over 527 meetings financial year to date with groups domestically and globally, covering all sorts of things. And, you know, I think that would be a stretch for an advisor to do that in the firm, plus see clients. So I do absolutely believe it's a specialised part of the market, because, you know, you need to understand, you know, a whole host of things that may not necessarily be so, you know, clear if you're just doing on the advice side. But yeah, our team's small. We've got operations and support around that, clearly, but you know, it works for us.
Yeah. So so do you have independents on in your team? You've got external consultants who actually help you with that, or?
No, we don't. So our portfolio management team's all internal. Board though does have an independent on there from a board point of view, but the board doesn't provide, doesn't dictate, you know, from an investment management point of view. No. So we, as I said, we feel that we can get what we need in that sense from the team. If we wanted to do a piece of work, and we've done that over the years, we might outsource that to, you know, KPMG or something along those lines. But as I said, you know, the core of it is all done internally.
Yeah, cool. And if I pass over to you, Matt, so if you look at the structure of your team on the investment side, how's that work?
Yeah, so as I mentioned, Paul, before, and we take our asset allocation advice from State Street Global. So they set with us a strategic, which is a 3 to 5 year kind of anchor benchmark, as well as tactical quarterly asset allocations. So they give input into our investment committee. There's 14 on our investment committee, ranging from our research, compliance advisors. We've got a couple of C-suite members that sit on there, but importantly, we've also got 3 external consultants on our investment committee. So asset consultants who have a right of veto over any decision that's made or put before the committee. So they can do that either in isolation or in combination. So the investment committee is making those calls on asset allocation as well as individual investment selection. As far as the investment selection is concerned, we've got an internal research team of 10 that feeds that research into the investment committee for approval. So it's a fairly sizable, I guess, process and team that we do run. But I guess from our perspective, one of the key aspects kind of is that governance overlay that we do have with our externals.
Yeah, absolutely. A question just more broadly. So if you look at these businesses you've now built, and beside advice businesses, do you see them as a profit center for the advice business, or are they standalone entities? And do you then have directors who share, you have co-directors, and there's always problems with that. We'll come back to the conflict piece now, Piers.
Well, look, we see it absolutely discreetly. So we have our own P&L. We charge for our IP. We think it's valuable. You know, it's up to the client as to whether or not they want to invest. You know, the conflict piece is managed through, you know, client consent form effectively, given that, you know, group shareholding owns, you know, both our investment management as well as our private wealth business. But, you know, I hold no bars about charging clients for the service that they're getting. I would add, again, going back to the rebate side of things, they're also getting access to fees and investment strategies they wouldn't normally be able to get access to. So, you know, I just think it's part of the value proposition. Yeah.
And Matt, in yours, is it part of the profits for the broader entity?
So I mean, if I look at our pricing is separated. So we have a 2-stream pricing model, which covers our advice fee for all of our strategic work, and then we have a construction fee or a portfolio construction fee, which covers the investment side of what we're doing. So we don't have a separation, I guess, as Piers is alluding to, in terms of the structural element of the business, as it all sort of is run internally. But we do separate those two components.
I think we might actually take this head on, because I actually think it's a worthwhile discussion. I know, Piers, you've got some pretty strong, not strong, but you've got some solid opinions on their fascination with conflict. And I think I don't disagree with them. So, but let's talk about this. I mean, did we just replace an investment model for the old funds management model? You know, the old AFSL model was you use someone's product and they pay rebates to the AFSL, they made money out of it. Okay, that was the old model. I think I look at this solution and I go, this is a far more tailored solution. It's built for the licensees, it's built for the advisor in that license, and it is actually, it's adding wealth advice value to it. But can I pass to you, gents, on that one? Especially Piers, I think this is one we talked about the other day.
Well, it is. I mean, you know, you make a good point, but Hayne didn't outlaw vertical integration.
No.
Right? They're vertical integration across, you know, multiple parts of the industry and multiple parts of broader financial services. I think we spoke about it, Paul. I mean, if I go to Price Waterhouse, they're not going to send me down the road to KPMG to get advice.
Yeah.
Right? So, you know, in the context of separation between the advice and the investment management, if there is an investment management business that sits within the broader group, I think that's where it becomes particularly important. And, you know, that for smaller players, I think is a challenge if they're not going to resource it. Now, I note there one of the things you could completely outsource it. That's fine. And if you have an outsourced model completely, one of the disadvantages we would say with that is how you then have a high level of engagement potentially within your network. And I think that, you know, this is why we see it as advantageous. And again, we, you know, run seminars for clients where a client, you know, a large client maybe in a strategy, we will happily, you know, go into a meeting to outline, you know, our market views and why the strategy's, you know, got its current structure in place, all those sorts of things to be able to support the advice model. We won't be there to advise the client. It's about providing that information and, you know, what I would say is a high touch point. So I think there are a lot of advantages, but it has to be set up appropriately. And that's why, you know, we certainly don't believe that an advisor should be advising a client, yet also be a portfolio manager in the context of operating a managed account. That's an inherent conflict that I think you cannot get around.
Yeah,
Agree.
And so I think, Matt, and I'm not quite sure your kind of structure, but I know the FASEA issues are all around simply, is there a line of sight of conflict? Is there a material benefit to an advisor to recommend this? Okay, there's probably some functional benefits and efficiency benefits, but advisors in your groups aren't receiving income based on using a model.
No, absolutely not. And look, that they're unable to.
Yeah.
And so I guess, look, there are many variations on the theme, aren't there? There's no one form of vertical integration. And look, ours will be completely different from Piers and so on and so forth. And I guess the way we look at it is to say if clients are fully informed, it's transparent, everything is disclosed and the client is in agreement, and we're genuinely acting in the client's best interests, then there can be a place for it.
Yep.
Yeah, I couldn't agree more.
Yeah, I think one of the other things, and you've raised it there, Piers, is the engagement through the group. So, yes, you could sit around and just pick managers, but the truth is that if you've got a team which is really part of your broader AFSL group, I suppose, or the part of the parent company, and you can have those real discussions with that group about why this is there, that's not there, even to some extent influence the direction by raising pieces. I think that's how you get engagement. And I've actually been surprised how rapidly advisors have gone, yep, okay, as long as I know it's in there, I understand it, I actually understand. I've got a team member who can explain this to me in my practice because they're actively engaged with the investment committee. It's amazing how rapidly they go, yep, that's great. I'm just going to get on with doing the advice now. So
yeah,
I that's just
equally on that too, Paul. Is you move away, or we're very focused, as said earlier, about having a solutions-based approach. You know, everyone wants every decision they make to be a 3, 4, 5 bagger. Well, it just doesn't happen like that, right?
Yeah.
And I guarantee, you know, you know, we get as many wrong as we get right. But if we're on the right side of the ledger, call it 65% plus, we're going to add value to our clients' portfolios over time. And I think that this is one of the advantages, certainly as I see it looking into the industry, that if you move away from being, you know, I'm great at picking this stock, I pick this manager, it's done wonderfully well. You know, that's Matt made a good point. You know, in 08, leading up to 08, you saw so many people say that they were, you know, they could do no wrong. 08 happened out of nowhere. Then all of a sudden you saw the rise of indexing, because it all of a sudden facilitated, well, the market is the market. And, you know, then you blame the market. You don't blame the decision-making that you chose X fund or X stock over something else. And that's why we always come from the perspective of solutions, because are we delivering an investment solution that suits the need of the client? It's not always going to deliver in a straight line, linear fashion to what the client's outcome needs to be. You're taking on risk, therefore, part of that is, you know, how you best manage that, but you're not going to get that 100% correct all the time. And I think that is one of the advantages when you do separate that advice piece out from the investment management piece, because then you can have a holistic conversation. You can draw a line in the sand with the client, again, to Matt's point around transparency and the client understanding. And then you have a professional come in to be able to articulate the rationale. Now, they may not get it right the entire time. The client might not like what they're hearing, but it doesn't break, in our view, the relationship between the advisor and the client, which is the most important element.
Yeah, very much so. All right, gents, we're coming up to close to time, so I'll be passing back to Toby shortly. So we've now gone through, we're obviously in a, the line we used, and I've used it in the previous webinars, is with the last 10 years is not going to be the 10 years we're about to come into. The world has changed out there a little bit. If you're looking at your businesses and the growth in managed accounts, and that's all changed as well. Execution speed has picked up. The quality or the number of options has improved. Or you know, for a new entrant, they're probably getting an easier ride into this sort of space than those who started off in 2015, 2013. So can I throw to you, Matt? Yep. 2023 and beyond. Have you got any thoughts on how Findex may actually manage these next 10 years? I know it's a long way, but even the next 2 or 3.
Look, I don't think we'll always refine our process and so forth. I think it comes back to a lot of what Piers was saying earlier on, or could have even been yourself, Paul, around there'll be a lot of evolution in the platform space and in terms of the innovation that takes place with products. So it'll be a matter of just keeping abreast of what they are. I think the efficiency speak for themselves. There's going to be enormous growth in this space, so it's not something that we will depart from anytime soon. But you know, looking forward over the course of the next 10 years, I think we will we'll be looking back on where we sit now and sort of saying, well, look, we've come a long way from then. But as to what that will look like, your guess is as good as mine. But all I can say is that we've seen a lot of evolution in the last 10, 15 years. I can only imagine it's going to be exponential.
Yeah, having said that, you're swimming against the tide. I mean, we had a lot of institutional licensees disappear, but you have to say Findex has actually grown substantially through this, and as has Viridian. So, yeah, you're both. Are you seeing opportunity?
Look, I think we firmly believe we're in a sweet spot because of those aforementioned. We've had a lot of the large institutions fall by the wayside. There's no doubt about that, and so unfortunately, it's just given rise to further unadvised Australians out there, non-advised Australians who have lost out as a result. So we actually see, from our perspective, we're surviving, you know, very, very strongly, and we're going to be the prime beneficiary of. We would like to think of that, of that change that's taken place structurally.
Okay, fair, cool. And over to you, Piers.
Oh, look, our view is the industry is going to continue to grow. I mean, if we saw it probably 3 or 4 years ago, well, even over the last couple of years, we've gone from 60 billion to 130 billion, and we'll probably be at 200 billion north of that, within either the back end of the year or early part of next year. So clearly, advisors, firms, and clients see the value in what the managed account framework can offer. I would like to see platforms and the administration side of that evolve at maybe a quicker rate than what they have to date. I think that's in some respects held back some of the innovation. But that would be something that I think will naturally occur, given the fact that, as look to any of the major platforms, that managed accounts are the fastest growing component of their offer. Your point around size, I think, is an interesting one, Paul. We've certainly done a lot of work on this, and we've seen it in the industry super funds regarding aggregation. Our view is that it's going to be increasingly more challenging for smaller practices, individual self-licensed advisors, as an example, even though individual self-licensing may come in, but to operate in a meaningful way that ensures they can deliver on the clients, but it equally makes them a profitable, sustainable, growing business through time. So I think that there's going to be a lot there, and I think the investment market will change in the context of what opportunities through managed accounts, what opportunities can be delivered to clients. And I think that that's, from our perspective, very exciting in the way that we're having conversations with externals around how we can deliver into that.
Yeah, terrific. Thank you, gents. All right, on that, I'll pass back to Tobe.
Thank you very much. I've really enjoyed the conversation and the sort of focus on the way in which the managed account service offer is made integral to the advice offer. I guess just to pick up on the last points that you were all talking about, as you see your advice segments growing, to what extent do you see you'll need to adjust your managed account service offer to reflect that, or will you need to adjust your own kind of managed account portfolio approach to the change in your client base?
Well, look, from our end, Toby, as a provider of IP, you want to make sure that you're relevant to the client base. So, that would be probably the starting point from which we would gauge that. And if we're not relevant, we're not going to be used. If we're not going to be used, we're not going to be able to turn a dollar. So you've got to be able to make sure that you are providing solutions that are suitable and that ultimately are accretive to the client's outcomes.
I think I totally agree there. I think from our perspective, it allows you to be very scalable in terms of what you're offering. So it can allow you to grow as a business and not incur those growing pains, if you will. It allows you to absorb client bases and operate efficiently as you go along. So I actually see that it sets us up very well for future growth.
Yeah. There's that one last question, Paul, which we might touch on. I think it's an interesting one, and that's the extent to which either of you have sort of. I know Findex have just been through a major technology project. The extent to which you're starting to think about blockchain and the ASX, obviously, or smart contracts, or the sort of evolving technology, and whether that's sort of a step beyond your immediate concerns or something you're already starting to think about.
Well, John, we've got 23 people internally in our tech team, both onshore and offshore. So we see technology as a critical component by which we can deliver outcomes to clients and do it in a manner that is scalable and a manner that is appropriate for our business. And we recently went through one of the elements around B Corp certification. And, if anyone on this call has done it, they will know how challenging that is to get that certification. And, your IT framework and how you think about technology is a critical component part of that. So, without it, businesses won't be successful in our view. It's how you integrate it and how it then fits around sort of the core construct of the business. So, that's how we look at the importance of it. And we spend a lot of money on it within the investment management part of our world as well, as you know, Toby.
Yes, yes, indeed. Yes. In fact, that was actually quite an important part of your submission in previous years to the awards, of the sort of the role of technology in the portfolio management process.
Just on that one, Tony, Tobe, just I think your last one there, because Andrew Inwood actually has been in quite a lot of presenting on this recently, and it's interesting. When people think about their tech stack, they're thinking usually internally, but Andrew is pointing out that really the UK experience is that the platform provider becomes a very integral part of your tech stack as well. And I think that's how people need to start thinking about this, because they can deliver a whole bunch of efficiency, whether it's through managed accounts or whether it's just through transaction speed, a whole range of things, which becomes part and parcel of how we're delivering our advice as well.
And that's that just from our perspective, that's where we're heading. We've got all these individual components, some of its parts, but it's now it's a matter of connecting our, and as Toby you alluded to, we've gone through a huge technology spend in bringing our various CRM platform, client portals, the production of our advice all together digitally. There's still a lot of work to do in that space, but this is something that the industry is just going to be moving further and further towards as we progress, so that not only do you get the efficiencies of the managed accounts themselves, but then the delivery of advice that goes around that as well is something that's just equally as important.
Yep. Yep. Well, look, gentlemen, thank you very much for your time. Paul, in particular to you, thank you for the effort you've put in throughout the week and in the...
We got there in the end, Toby.
and in the briefing sessions. It's never apparent to somebody who agrees to be a moderator for MOMAP series at the start quite how much work it is. And I hope that you've enjoyed it and perhaps learned something as well. But
they're really fascinating businesses. So thanks, gents, for sharing too. So I think really appreciate it.
Thanks for having us. Yeah. Thank you very much.
Yeah.
So look, just to remind you that coming up from IMAP over the next month or so, the awards, quality of advice review. I'd encourage you to attend that if it's something of interest to you, and advice in action in the 3 major cities. So thanks very much, everybody, for participating, and we look forward to talking with you again soon.
Thanks, everyone.
Thank you.